Okay, so now we're going to get started. Share this. Okay. Well, thank you everybody for joining us for this market update, calling it Trump 2.1, How to Invest After Trump's Tariff and Immigration Policy Changes. So we will get started talking about different things going on in the world. And let me see. So basically, just to start out over here, not to get too a lot of people, get a little, all the anxiety about what's going on in the markets, what's going on in the world. So I thought I'd start today by just talking about, generally over a long period of time, going back to 1800, the markets do just fine, and so that, not that that's your time horizon of looking at things, but over a long period of time, companies that are making money will generally make a lot more money than gold and bonds and things like that. So I just wanted to start by talking about that. And then when you look and see, uh, since 1900, again, the market's had, incredible growth. We did have a period from 2000 to 2010, and the market didn't do all that great, but over a long period of time, the market does do really well. Now, with a pullback in the market recently, the market started out the beginning of the year, it was fairly expensive, and now it's really, pretty much right around the average right now. So, and again, I did these charts that you'll see the different dates on here. This was done as of April 9th. And from a valuation perspective, you know, basically the market's a little overvalued in certain metrics like price earnings ratio and dividends yield and things like that. But in general, it's not quite as expensive as it was at the beginning of the year. Um, so when you look at this at various inflection points, the market has gone down, and there could be more opportunities now going forward. Um, Over a long period of time, despite all the terrible things that have happened, in 1987, we had the stock market crash, we had the stock market crash of 2008, after all those really horrible days, because I had people telling me, including my son, who was asking me, why don't you just go to cash and kind of sit this out? And what this kind of shows you, after these really horrible days, after the 10 worst days, we generally experience some of the best days. And as you may recall, like the market was really going down a lot. And then Trump made an announcement about pausing the tariffs for 90 days. And lo and behold, the market had one of its best days at that point in time. Um, and when you see the perspective, all the different times the market's gone down. You have drawdowns just about every year. This is something when if you listen to my other seminar that I do, which is actually a lot more important than this one. This one's about what's going on in the market. The other one's more about what to do. When you look at this chart, it kind of shows you that even with the market going down at some points in the year, over a 1 year period of time, that generally the market does go up. When we looked at the market starting out at the beginning of the year, looking at it, looking at the various things that you would be positive or negatives, monetary policy, we do have the Federal Reserve, which is expected to potentially lower interest rates. Manufacturing's about average. Consumers are doing well. Their consumer balance sheets, we'll talk about that some more. And for those of you in real estate, talks about home prices continue to increase. And, but the, mortgage rates are still fairly high and the home sales are moderate. And, while unemployment rate has increased, jobs are plentiful at this point in time. But we'll go into those in greater detail. This is something that I thought was interesting. It kind of shows you, like, of course, the hard part is here is picking what kind of market you're in, but it kind of tells you the particular things to invest in, depending upon whether you think it's going to be a mild recession or a resilience with slowing growth and sticky inflation. And these are the various things that you might want to invest in those particular markets. Now, when we looked at this at the beginning of the year, 2025, we talked about the Magnificent Seven, the high valuations relative to historic levels, relative to the rest of the market. And we'll talk about that some more later on in this presentation. Um, and it's very concentrated in those top 10 stocks. About, when you look at the price earnings ratio, those things at the beginning of the year, they were kind of way out of whack. When you look at the policy uncertainty, all the different things that are going on with the Trump administration has led to a lot of uncertainty. And it's really pretty much the highest it's been in a long time. Um, this is something really looking at this from the period of, what they're looking at about the trade and things like that. The policy continues to be a negotiating tool, and this is something we'll debate later on as to whether Trump is using the tariffs as a negotiating tool or whether he's looking at it as a way to raise revenue. Um, then we also have the risk of immigration and what's going on with that and how many people they're deporting, and we'll see what that can do to the overall economy. And then, to counterbalance these things, we have what's going on in Washington with the Republicans controlling both the House and the Senate. They can pretty much get what they want done. And it seems a certainty that the Trump cuts tax cuts are going to be extended. They might actually. It looks like the state and local tax deduction will actually come back in place. There might be something excluding taxes on overtime and tips, and they might lower corporate tax rates for domestic companies and domestic manufacturers, and all these different things. Also, with regulation, there's a lot of things that can help the economy as far as that goes with antitrust, less antitrust enforcement, energy, easier approval for things, and also the regulatory burden on some consumer finance firms. And that's something that is debatable as to whether those things are good or bad, but this is generally good things for the market. Um, when you look at this, the policy views, it looks at again, there's a lot of policy uncertainty right here, and the trade outlook. There's a lot of things that are subject to potential tariffs, and there's things that we're looking at, and actually every day there's new things they're talking about, things on pharmaceuticals and medical equipment and things like that. So these are all things that they're going to be looking at. And again, I realize I'm going through these slides very quickly, and there's a lot of information on here. And this seminar is all going to be recorded, so people could, get out these slides and they can study them, to their heart's content. As far as the economic growth, it talks about, the last leg of inflation is proving really tough to get over. Like the Fed would like to get inflation down to 2%, and that's looking like that's getting to be difficult as far as economic growth. It's still the economy is still growing. The tariffs are going to have an impact on that to some extent, but we'll see what's going to actually ultimately happen with the tariffs. And we do have a tight labor market right now, but there's a lot going on with that then too that could change. Um, Monetary policy, what's going to happen with that? They keep on changing as to what might transpire with the Fed and interest rates, and they're talking about potentially cutting a couple times. I think that's the consensus right now. Now, and they're looking at different things going on with Congress, and these are all the things they're looking at as far as things going forward. Now, as far as like as of April 9th, this kind of shows you, like the beginning of the year, we showed that slide, but this showed you that MIFs and 7 stocks, which are really driving the market, those really went down the most. They went down about 18.3%, while the US market went down about 7, and emerging markets went down as well. But these other places in the marketplace actually did okay, like commodities we'll talk about in a few minutes about gold and things like that. Areas in the market that actually did okay. Um, as far as the equity sectors, it was basically the ones that were driving the market in the last few years, like information and technology. They went down a lot, and consumer communication services also went down. Um, so there's a lot going on in the marketplace, and there's things to look at with regards to that. And this talks about job growth. It remains healthy. There's still a lot of jobs out there for people who want them, and that's actually a positive for the economy. Now, as far as oil, one things that Trump wanted to do is to get oil prices lower, and it looks like in the last couple of months, oil prices have gone down lower, and that's partly attributable to the fact that there's a potential of a recession coming on, so that's why oil prices have gone down lower. And we'll talk in a minute about gold. Gold prices were really on a really great run. It was actually one of the better performing things this year. It's gone down a little bit recently, but in general, gold is something which I know that the central banks of the world are actually purchasing as a way to diversify from the dollar. So that's actually an interesting thing to maybe have a little bit in people's portfolios. Um, Now, as far as what's happened in the market and the dynamics, like in the last few years, growth stocks were the great performers, but in the first quarter, value stocks have actually started to outperform. Um, Now we're going to get to the main part of the presentation, talking about tariffs, which is the thing that everybody's been focusing on. And you can see like going back in time, like tariffs have gone, you know, really were really, really low for a period of time for like the last 30 years. And what Trump is trying to attempt right now is actually unprecedented as far as this goes. Going back into even the 1930s, even these weren't quite as high, these tariffs. And the question is whether these are just a negotiating tool, or whether it's something that he's hoping to have in there. And there is some logic to having some tariffs to try to protect manufacturing in this country and what's going on with that. I think that they just maybe tried to negotiating against the whole world at one point in time got to be too much. So we'll see what happens with this 90-day reprieve that we have over here. But even with that, what Trump has already instituted, a 10% tariff, that's huge compared to what we had before. That's like 10 times what we had before. And even when I was doing this market update just a few months ago, all the pundits out there that I was studying was thinking that maybe tariffs would go up 2.5%. So this is already just the 10% tariffs we talk about across the board in all these countries. That's 4 times more than everybody was thinking about the beginning of his administration. And again, this is what they're trying to do. Why is Trump trying to do this? He's trying to promote economic growth, expand market access, boost innovation and competition. That's what they would do with free trade. And tariffs, you want to try to protect those domestic industries and correct the trade imbalances. So that's really, the difference between free trade and tariffs. And it's kind of interesting to see what's transpiring over there. But we'll see whether Trump is using these as more of a negotiating tool or whether he's using it as a way to raise revenues to do tax cuts, which is some people think that might be what he's doing as well. And all these trade barriers you've had across the world, these are things which have actually, there is some countries do have, a trade imbalance with us, and what these are going to try to do to try to lower that. So these are actually things that are, going on. But when Trump did these calculations on the tariffs, he included things in like currency differential and value added tax and things like that, which don't really have that much to do with overall, what's going on with countries and things like that. So it's just there's a lot in there that really has to be studied to see what ultimately is going to transpire there. And of course, everybody's going now to the United States to negotiate with regards to tariffs. So we don't know what the end of this story is going to be right now. And again, these tariffs are expected to be, the highest they've been in over 100 years. So, so we don't know the ultimate result of this, but these are really high compared to where they were just about a few months ago. So, and this kind of shows you what countries tried to do. The trade pattern has shifted from the first round of tariffs. In the past, when we first started, China was the big percent of total imports. And so what countries did is they moved a little bit more towards Europe and to Mexico and things like that. The concept of nearshoring is something where companies would say, we don't want to necessarily have things in China. Let's move it to Mexico where it's closer to where we are so we don't have to deal with all these supply chain issues. But companies went and did that, and now there's a tariff on Mexico as well. And the tariffs in the past, they did have an increase in the consumer prices as a result of that, but it remains to be seen as to what the result of these tariffs will be now. A lot of people do think that the tariffs will ultimately increase prices, and we'll go through an example to show how that might work. Now the question is, the tariffs will raise customers' revenues, will slow economic growth, and this is where this is what the question is like right now. If tariffs are actually instituted, they will raise a little bit of money to go into the U.S. coffers, but the question is, what impact that'll have ultimately on gross domestic product and the economy. So this is kind of an interesting example. which kind of talks about one car parts journey through the US, Canada, and Mexico before tariffs. So this kind of shows you that they would buy raw aluminum to manufacture a piston is shipped from Michigan to Ontario. Then the piston is cast and pre-machined and then sent to Michigan. Then the piston is sent to Mexico to be finished. Then a piston is sent back to Wisconsin, gets assembled with rods and rings and then sent to an engine plant in Michigan. And a piston is to put an engine in Michigan, which assembles then put in a vehicle assembly plant in Ontario. And then the vehicles are shipped to the US and Mexican, Canadian exports. So, so the point of this is that this is really complicated. You talk about this is one simple example, and it shows you how these companies have kind of figured all this out to try to, and they think make it the most efficient way of doing it. And now when you suddenly have tariffs on Canada and Mexico, this gets to be infinitely more complicated for companies to deal with. And I have some executives who work at some companies around here, and they're trying to deal with what's going on with tariffs, and it basically is making it a little more complicated. This is the example I was talking about, just as a cup of coffee, just to show like a cup of coffee now costs like $4.29. There's a tariff on the Colombia of 10%. That will add a penny to it. And then you have a machine tariff on there, which would add a penny to it too. And then you have the disposable cup, which is a tariff on that as well. So the new cup of coffee is going to cost, in this example, about 20 cents more. So this is just, it's kind of complicated, but simple example as to what companies are going to be dealing with respect to these tariffs. So when we look at this and we see what's going on in the world, you know, who are the people who are spending the money? The top 20% of earners make up a disproportionate share of consumer spending, accounting for slightly more than the three lowest quintiles combined. So, so what's interesting about that is, the wealthier people actually go spend more. The lower income consumers are facing headwinds, but maybe the wealthier people can bail out the economy. Now, when we'll see later that it's the lower income people who spend more of that proportionate income. So it's nicer for the economy if they actually have more money, which is what happened during COVID. They went and spent money, but in general, this is something that could uh, help that's going to help the economy by having the wealthier people spend their money. Now, let's talk for a second about immigration policies, because this is one of the questions out there is really Trump's been talking about how many people he wants to deport and what's going on with it. And, I think the latest things I was reading about is really the most he might be able to deport is, the net job loss will be like 500,000 people a year. But this is showing what would happen, with 1 million deportations a year and what would happen to the labor supply. And this would be this would be a growth headwind for the economy if these people left the country because they are doing a lot of the work. People are on your roofs. People are picking your fruit. People are cutting your meat. People are doing all these different things that you don't really notice them, but they're here and they're doing a lot of the work that a lot of the people in the U.S. don't necessarily want to do. So it's somewhat controversial. They have pretty much shut down the border right now. There aren't many people coming across the border, and they are deporting a lot of people. So, but it's not going to be quite as many as I think that they said they were going to deport. Now, this is actually one of the more important slides out here because this actually talks about the federal deficit that we have over here. And I was just studying this. One of the things that they talked about is that Musk with the Doge is actually out there trying to cut the deficit, and I think they're finding out it's much more difficult to do than they said originally. But even when you look at it proportionally, like the overall budget is only 14% non-defense discretionary. So it's going to be very difficult to, even if you laid off all the federal workers, you still wouldn't make pretty much a dent in the rest of in the overall deficit that we have over here. And you're not going to lay off everybody in the government. That's just not realistic. So it kind of shows you, and this is really the big concern that I have over here is the net interest that you have. This is the problem is that, basically if you ran your household by every year, you know, spending more money than you're taking in, you would be in big trouble. And that's what we have right now. And we'll talk about in a second, and also what's we're talking about later is about with the extension of the tax cuts that they're talking about here, the deficit is projected to get even higher at that point in time. So, and one of the things that the economists I was listening to were saying is that one of the things that leads to a trade deficit is actually having a budget deficit. So that's something that's out there. You really kind of have to think about how you're going to kind of get your house in order. And you know, if you can do one of two things to balance the budget. One is you can cut back on things, and it's going to be very difficult to cut back. You can't cut back on interest things, Social Security. That's like the third rail. Medicare would be difficult to cut. They could back, they could cut back on defense, but that's difficult to do. So it's not a really easy thing to do over here to cut back on all those different things. So again, when you look at the tax cuts, the impact on the deficit, there's, this is what you're looking at is that this is the deficit you were expected before. And now if you do the tax cuts, the deficit will be even greater. So again, you don't normally, if you're trying to balance a budget, you wouldn't necessarily cut people's taxes, but we're looking to cut taxes, which should have a stimulative effect on the economy, which should help the economy grow to make up for some of the headwinds we might have from the trade imbalance, the tariffs and things like that. Uh, but what's interesting about this is that what happened in the last couple days before Trump kind of uh, cut back on the tariffs he was talking about. What happened is we had a really volatile period of time in the bond market where interest rates suddenly jumped up. And what happened, as I was reading about, is that a lot of the countries out there who are lending to us, they actually started selling treasuries over there. And this is a concern when you owe a lot of money to a lot of countries. They can control pretty much by selling off your bonds. If they raise the interest rates to us, then we have to pay more on our debt, and we have to pay more for everything then too. So it's kind of a delicate dance that we have to do right now because we don't want to have we want to keep interest rates lower, but that's sometimes not in our control because we have a lot of foreign governments and foreign people that own our debt. Um, so this is kind of an old slide from back in December, and it shows you what happened, and it was talking about what might happen with semiconductors, that there might be tariffs on that, so they didn't do quite as well. Software did a little bit better. And it talked about things like Bitcoin doing well, which did well up until December, and now it really hasn't done quite as well since then. Um, Now, when you look at this, this is actually showing you like which is shows you the value of rebalancing your portfolio because if you started out with just basically a 60-40 portfolio and like fixed income and you had international and then you had US growth and you had US value, it kind of shows you what that portfolio has turned into. So here it shows you that it's going way out of whack. When you look and see the large cap growth has gone up to a large extent. It was even larger in January and as had the value. So it kind of like that's why you want to rebalance because even by just letting things ride, you get to end up taking a lot more risk when the market has a downturn like it did. And that's why it's important to rebalance portfolios. So when you look at this, it kind of shows you the returns and valuations by style. Like most of the areas of the market are still expensive, but there are areas of the market like small cap value and mid cap value that are, like under their 20-year averages. So again, it's, there's areas of the market that are less expensive than others. Um, Now I found this interesting when I was looking at this. It's like the small and mid caps and large caps, like what is in mostly the large caps. Information technology is like 29% of that, and that really is the only area where it's greater than mid caps and small caps. And mid caps and small caps have mostly financials and industrials and healthcare and things like that. When you look at the breakdown of the growth and value, there's a lot more value in the small caps and the mid caps than there are in the large caps. So it's just kind of an interesting to see the breakdown of those things. But when you look at the small caps, there's a lot of companies that are actually unprofitable. there's actually a metric which one of the investments that I have available where it talks about a simple measure to see how to beat the market over a long period of time. And it was a simple thing they said is if you just invest in profitable companies, you'll make more money. So it kind of shows you have to be careful about all these unprofitable companies that are out there. And there's ways to screen those out of that. Um, so let's talk for a second about the Magnificent Seven stocks. And it shows you, um, the Magnificent Seven had great earnings for the last several years, which really, help to drive their valuations and their growth. Um, but the problem is that for them is that the earnings of the rest of the market is actually starting to catch up with the Mag Seven. So that earnings advantage is dissipating over time. Um, and as long as they don't have that superior earnings growth, the other companies which are valued less than that are actually helping to narrow that difference. And that's actually what's transpired in the last month or so, with the Magnificent Seven stocks going down a fair amount. Um, this I thought was really fascinating. I think there's somebody who has their is not muted, so if somebody can mute themselves, that would be great. Um, so the Magnificent Seven, I found this really fascinating. When you look at the country weights of like China, France, Canada, United Kingdom, and Japan, compared to these Magnificent Seven stocks, these seven stocks have a greater capitalization than all these countries combined by like over 6%, which I found to be really interesting. So you get to see how big these seven stocks really are in the world index. Um, Now, large stocks have done really well in the last several years, but more recently, the other stocks have actually started to do better and to narrow that. And that's one of the themes which we added to the portfolios by not overweighting to these top stocks that they had in the past. This kind of shows the Magnificent Seven. There's a big difference between the winners and losers of even those seven stocks. And it just shows you the valuations of Magnificent Seven are much more expensive than they are of the rest of the market. And it kind of shows you that there's been big losses in the Magnificent Seven stocks. Um, so when we look at this, basically over a long period of time, when the top 10 stocks, the weight of the stocks in the S&P 500 of outsized share, equally weighted stocks generally did better over that period of time. So that's kind of the market we're in right now. We're still, even with a market downturn, those top 10 stocks are overvalued. You would think that over the next few years, that the equally weighted, not having a concentration toward those stocks would actually make more sense. And again, the valuations of the top 10 stocks, the weight of this is like an all-time high. I think it's 34% is in those top 10 stocks. And those stocks are actually, they're spending money on research and development, and they're doing the right things to grow their companies. They're not like companies that aren't profitable, but just from a valuation perspective, they're fairly expensive. Um, Now, what are the technology companies doing? They're out there and they're spending a lot of money on artificial intelligence, and there is a lot of growth in this area. It's something that does make a lot of sense to have some things in there. Again, that's one of the things that we'll talk about in a second. Like, what's going to happen? Like, if they do bring back manufacturing to the United States, um, what I think is going to happen, if that does happen, is that these manufacturing plants that are here won't necessarily have 10,000 workers. They'll probably have a lot of artificial intelligence and robots and things like that. So I think that there's still a lot going on with artificial intelligence that makes sense to have that. And these companies are spending, putting money into intellectual property and research and development and equipment and structures and things like that. Now, what do they have to do to get these artificial intelligence type things? They need a whole lot of electricity. And there's some people who work for utility companies here on the phone call. And those people, that's one of the key concerns is where are they going to get all this energy from, the electricity, to get all this artificial intelligence centers. And it shows you the data centers, the demand there, the growth of that's going to be huge. And even with the things that Trump is talking about doing, he's talking about there will be a lot more electric vehicle charging stations in the future. Now, as far as artificial intelligence, there's going to be a lot of productivity increases in this. And it kind of shows you like after, what happened in these various areas and 10 years later, what the growth was there. So I thought this was kind of an interesting slide that people can study later. And this also shows you that, it's not just what you would think in technology where this artificial intelligence is going to really help. There's going to be advances in healthcare and data security and transportation and automotive and agriculture and social media and financial services. There's a lot going on with that. And the U.S. is kind of putting their money where its mouth is. There's a lot more data centers here that we have than anywhere else in the world, and that's what we're doing. But other countries are trying their best to keep up with us. Um, and this is kind of showing you that where these companies are looking at and which companies are putting more into artificial intelligence to produce goods and services here. Now, this is really one of the key things when you look at like what is growth? What makes gross domestic product? And this is a concern that if what it is basically the growth in the real output per worker, um, and it's also the growth in real GDP. But you need to have the growth in workers. If you don't have enough workers, you can't have as much growth. So it's one of those concerns that if you limit immigration too much, you don't have enough workers to build things. And there is an argument that maybe the robots and maybe artificial intelligence can help our productivity, which is what a lot of other countries who don't have growth in their populations are utilizing. But it's just that's the thing that I'm a little concerned about. You do need workers to produce things. Everybody on this call who's maybe retired or people who are retiring soon, you need to have somebody who's producing something, and they're going to be making money for us so we can get our Social Security and our Medicare and things like that. So when you look at this, the source of earnings growth and profit margins, it kind of looks at all the different things here. And generally, you want to have increasing margins and revenue. And basically, this is all good. But there is a concern that if the tariffs go into effect and the corporations can't pass on these prices to consumers, this can cut back on their margins a little bit over here. So the profit margins could be squeezed a little bit from that. When you look at the forward price earnings ratios, like it's not as important in the short term as to what that might happen with the market, but it generally, it's kind of intuitive that you'd like to invest in a market over a 5-year period of time when the market is less expensive. So when you look at value and growth, it basically shows you where they put who has more corporate cash. And I found this interesting when you looked at this to see that the technology and the commercial consumer services things, they have a lot more money in cash than you would think. They're also spending a lot more money in research and development as well. So when you look at the top performing companies here, it's basically the value and growth, the breakdown of that, and the relative valuations here. So this is actually the key driver of the economy that we'd want to talk about here is that this is what is really driving the economy is 70% of the overall gross domestic product comes from consumers spending money. So it's not really all the stuff we're talking about with the government and what they're spending money on. That's only 6.5%. It really comes down to the consumers and are they going to spend money going forward. When you look at this, the consumers are actually in great shape. Their balance sheets are really in good shape. The mortgages are getting to be a lower percentage. Their household debt service ratio is lower, but they're a little uptick in delinquencies from some of the things that are happening with that. But in general, the consumers are actually in good shape. This is actually an interesting slide that I added because we talked about the raising interest rates and the impact it would have. But the thing is that most people out there actually locked into lower rates. The current year fixed rate is is 6.1, and the current is 3.9 is what the people are paying on that. Because So that actually is why, the impact of these Fed rate increases hasn't been quite as dramatic as you would think, because most people, refinanced and they have really low rates at this point in time. What the problem is it's going to make it difficult for people like my kids to be able to buy a house in the future, because they're going to have to pay at that higher rates that they have over there then too. Now, this is kind of counterintuitive, but it shows you that consumers are now pessimistic about the economy, consumer spending and saving. Their consumers are are cutting back a little bit on what they're spending. But in general, when you look at it overall, the consumer confidence has gone down a little bit. Manufacturing is about even. And the consumer sentiment is out there then too. But in general, when you look at it, this is kind of an interesting slide. It's kind of counterintuitive. It shows you that when people really feel lousy about their confidence in the market, that's actually not a bad time to buy in the market. Because when people are really feeling lousy, it's generally after that, you can see that the market actually has some really good returns after the people think it's really lousy out there. So that's actually something that would be a positive right now, is that people aren't feeling all that warm and fuzzy about what's going on in the market. So when you look at this, the components of GDP growth, it's basically, the consumers are basically driving that. Government spending is really a small percentage of that then too. So that's why the consumers are really the key. This is just something I put in there just to show, like, despite what your political leanings are, you shouldn't just invest in the market when your guy's in office, a guy or woman's in office. You really want to be in there throughout, because generally the market goes up under either administration. When you look at the returns and valuations by sector, there are some areas of the market that are, undervalued, but not many. I mean, basically the market is fairly expensive. There's things like you can look at, like utilities and things like that, which are generally they're a little bit undervalued compared to what they're you know it, but really it's not. There really aren't any real bargains in any particular area at this particular point in time. As far as asset class returns, what you really want to do, what this slide really shows you, it's really difficult to pick the winners, which asset class to be in. What you really want to do is, you want to have a balanced portfolio that can kind of keep you in there through the long run, and that's why it's important to be diversified. This kind of shows you that diversification didn't really work in 2022 when interest rates went up a lot, but generally during recessions, which is what the potential is we have now, things like bonds and things like that actually do work out pretty well. Now, as far as like what you can have in your portfolio to kind of diversify, one of the things which we've been adding to portfolio is having a little bit more money in things like infrastructure. There's a lot of money that needs to be spent as a result of the Inflation Reduction Act. So that's an area that I like right now. But you also want to have some of these other things like private equity and hedge funds and things like that. That makes some sense to help. When the market's zigging, you want to be able to zag. Now, as far as CD rates, like everybody would think, oh, I just will sit this out and I'll stay in CDs. But what this basically shows you is that, after you might make a little money now, but you generally would make a lot more money in the future if you actually invested in the stock market or a 60-40 portfolio. So I'm going to take a sip. As far as changing interest rates, this is one of the big things that the people are looking at, is what's the Federal Reserve expected to do? And they're expected right now to probably cut a couple times, but that keeps on changing based upon what might be happening with tariffs and the impact of that. And again, the Fed is going to be challenged to get back to the 2% inflation. So it's there, but there's areas to show that the inflation has gone down when you look at it. We'll talk about that in a second. But I think it's expected that they will get a couple more cuts going forward. This kind of shows you where we're expected right now to make like 4.5% on a bond portfolio going forward. Um, but again, this shows you that of what you're looking at over here, there's really, it's not just the yield you're looking at things. There's a possibility if interest rates do go down that you can actually make a little bit more money on bonds than that. And this kind of shows you the valuation of bonds. And it shows you that generally across the spectrum over here, you're getting a really much greater yield than you were in the past. So bonds actually do provide more protection than they did when, you had 1 or 2% yield on certain things. So there is some advantage to having bonds in a portfolio. And this is really one of the key things that we learned a couple of weeks ago. Despite the Fed rate cuts, it won't necessarily result in lower rates because what happened, you know, what happened a couple of weeks ago is that basically, even though we had lower short-term rates, the people, other countries or whatever, stopped buying treasuries or started selling them, so interest rates did go up. And this is really another concern that's in there, which is also kind of interesting. And this is something that a lot of people don't focus on and don't think about, the Federal Reserve balance sheet. So what happened is, we had quantitative easing in 2008, and basically they printed money, and that helped to sustain the economy. And then you did another one, quantitative easing two, and then three, and then you had tightening over there where they actually started to buy back some of those treasuries and things like that. But then COVID happened, and compared to what had happened in the past, it was astronomical as to how much cash they put into the system. And what happened with that is that actually led to inflation because you had all this money into the system sloshing around. And when all that money went around, the prices went up. And then they started after that, the last few years, they started to take some of that cash out of the system, which which actually has an impact on the economy. So going forward, the Fed would like to keep on taking the cash out of the thing because they really want to lower their balance sheet. But this is actually going on behind the scenes, and people don't realize that that's something that's there. And this is another tool that the Federal Reserve uses to try to stimulate or slow down the economy. So they're trying to slow it down a little bit by raising rates and also taking a little cash out of the system. Um, Now, as far as the bond market, what happened in 2022 is really unprecedented. We usually don't get these big losses, but that was because the Federal Reserve was forced to raise rates, 400 or 500%. And in general, you don't usually have big losses in bonds, and that's why it makes sense to have some bonds in your portfolio. So when you look at this over a period of time, it kind of shows you the interest rates. We went from a period of time in 1958 to like 5% all the way up to 16%, and then all the way down to 4% now. Now, what's interesting about that is when you look at this from this historical slide, it shows you if you picked the right time and you invested when interest rates were going up, you would have actually lost money in bonds after inflation, which is important to know. Now here, when the rates went down from 16% down to the 4%, you actually would have made a pretty nice return in bonds. Not as well as you would have done in the S&P 500, but still it was a nice return. So it's just something to think about. Now, when we talk about inflation, which is really what the Federal Reserve is looking at, it's kind of interesting when you see the breakdown of all the different things going on in the economy. What was interesting is that automobile insurance was one of the things that was one of the key drivers of inflation. You also had, people spending money on food at home and energy, but energy's actually slowed down. That really is actually deflationary right now. But basically, what you look at these components here, a lot of people are spending money on dining and recreation and things like that. Those service things have actually gone up, and those have actually been inflationary. Um, so when you look at this over a period of time, food has actually still gone up, and energy's gone down. But this is what the Fed is looking at to see whether they can lower rates even more. Now, as far as the wage growth, people are still getting their raises. The unemployment rate is still, fairly low historically. So that's actually bodes well for the economy. Now, as far as inflation goes over here, it kind of shows you the various areas that are doing okay. Now, car prices did go up more than other things, but those we'll see what happens with the tariffs. They might actually even go up a little bit more as a result of that. Now, as far as the oil markets go, this is actually a really important slide because it shows you, we're actually drivers of the world right now because we're basically producing so much oil that we actually are making up for the shortfall of the rest of the world for that then too. So, this whole thing about drill, baby, drill, we are drilling and we are producing a lot of oil, which is actually helping. Now, the price of oil has gone down, which is actually helping our inflation. But and that's something that I think will continue if we have a recession. These prices will go down lower. But if we have any problems in the world with anything in the Middle East or anything like that, then that would lead to an increase in prices. But then again, you have what might happen with Russia. Maybe the Russia-Ukraine war will be settled, and maybe there'll be more oil in the market as a result of that then too. So, but in general, the price of oil going down is actually helpful for inflation. As far as labor supply, there is still a lot of labor being added, still a lot of jobs out there. But this is actually an interesting thing where it talks about the immigrant contribution. They're actually a lot of the people who are the jobs that are being added over here then too. So we'll see what happens if they have less foreign workers in this country. Now the labor market's starting to soften a little bit, but it's still doing okay. And small businesses are still hiring, but they're hiring less. There's less job openings than there were in the past. So when you look at this, generally when the Federal Reserve starts cutting rates, that actually the stock market does do well. So that's something that we want to look at as well. Now, as far as where you want to invest in the market, the bond market, there's all kinds of different areas of the bond market where, depending upon if you knew what interest rates are going to do, you would do better in certain things, like you could be in floating rates and do better, and to see what happened in different, so you really have to know what interest rate scenario you're in to determine, what type of asset class, type of bond thing to be in. So when you look at this right now, there's a lot of interesting areas in the bond market to invest in. So you want to have some money in bonds as well. Now, as far as municipal bonds, those are actually very attractive right now for people in high tax brackets, because here you're able to get a much higher tax equivalent yield than you were in the past. And these are actually really positive when you look at this compared to what you can get in treasuries. So, and you look at municipalities, they're actually doing fine. They're actually paying off their debt. And they're actually, they have a lot of money set aside for rainy day balances. So tax exempt bonds, they haven't done great in the last few years, but it could be a time for them to do well. So now we're going to talk a little bit about the world and what's going on there. And, when you look at the rest of the world, and we don't really know the complete implications of what might happen in a tariff war, but the rest of the world is actually less expensive than the U.S. And they also have greater dividend yields in the U.S. So it never makes sense to not have anything in international. And international has underperformed compared to the U.S. for the last 10 years. This last year, though, starting this year, international has actually started to do a little bit better than the U.S. And the valuations here are again much more attractive than they are in the U.S. Now, this is actually, to me, is a concern that people don't realize and don't really focus on, is what's going on with the dollar. And one of the concerns is that the dollar has done so well; it's made it very difficult for us, the U.S. Exporters, to compete. So what they wanted to do was to lower the value of the dollar. And actually, that's actually with these tariff wars, it's actually happened where the dollar is actually going down a little bit. But to me, you have to be a little, and I think we do want the dollar to go lower, but we don't really want the dollar to go too low, because we love having to be the reserve currency of the world, where people look to us and we can borrow with impunity. And it's one of the things that we have to be concerned about when we have a huge deficit and we have a lot of treasuries to buy. We don't necessarily want the dollar to go down too much as far as that goes. We also don't want to have a big, the trade balance is still fairly high, and that's what Trump is really working on, to try to try to lower this trade balance. But that's really what we're looking at. If our interest rates and the trade balance are what they'd be looking at to try to drive the dollar. And that's one of the concerns I have is that we want the dollar to go down a little bit, but not too much over here. And that's what they'll look at around the world over there then too. So the rest of the world is slowing down a little bit, but still doing okay. The valuations are better around the world. And when you look at this, the interest rates are all kind of lowering their interest rates around the world. And, the rest of the world has greater potential growth in these other areas of the world and emerging markets, and potentially in China as well. So I found this to be an interesting slide that I added in here, because you would think that the U.S. is the place to be, and we've had great performing global companies. But this is an interesting slide that shows you, if you would have just shown the U.S. performance and you would take out one company, NVIDIA, that the rest of the world is actually doing, keeping up with us. And you look at all the top 50 performing companies globally, there's an awful lot of companies that are outside the United States. So that's why you can't just have this view that just you want to just be in U.S. companies, because there are a lot of potential growth companies outside the United States. And this kind of shows you the average tariff rate on U.S. goods imports from China. And it shows you the tariffs have gone up a lot in just the last few months. And it kind of shows you over time, like what happened with U.S. good imports. Like we were importing a lot from China, but we started to do less. But then we started to actually have more imports from Mexico because people were nearshoring, and other places like that. We started to increase, like India, we started to increase because people wanted to get away from China. So it's difficult to navigate all this, because I have some clients that work for some companies that they're trying to build like manufacturing in different areas of the world. And it's really hard to build manufacturing in different places without knowing what the game plan is, because it might take you 5 to 7 years to build a manufacturing plant. So it's really hard to know, when you would, whether it's going to be viable if they start instituting tariffs to make it that much more expensive in that particular area you're in. So I think businesses right now are having a hard time planning, not knowing what the rules of the game are for that. So basically, this kind of shows you what's going on here. As far as the emerging markets, this is like a more long-term trend. When you look at the growth of the middle class here, this is really a big driver. There's more people in the middle class, they spend more money. And when you look at these other places, there's a much greater growth in those particular areas, which would generally lead to greater market performance. So that's one of the things. And it's not a short-term trend, but over the next 10, 15 years, these countries which have an emerging middle class, that they should be doing better with that. One of the things we might want to look at, the things we might want to invest in, is things like private equity, and look at these other things over here then too. But I don't want to keep you here all night. Basically, the emerging markets is something to look at. I think it's something that has potentially greater yields, and it's also something that has potentially greater growth. So with that, does anybody have any questions?
No. Nope.
So as an overview, as a summary of what's taking place,
Yeah.
Basically, what I think right now is that we're at this transition point where we don't really know what the market might do. We don't know what, really, when the tariffs were instituted, I knew it was kind of like what my clients are asking me, like, like they were panicking and saying, oh my God, the world is falling. But when COVID happened, COVID was something that I knew there would be sometime there'd be a cure, and sometime the world will be better from there. So I knew it was an opportunity to buy. With tariffs, I knew that ultimately one of three things was going to happen. Either Trump was going to negotiate with the rest of the world and they were going to capitulate, or Trump was going to back down from some of the tariffs, or it'd be Armageddon. I think that the Armageddon War was a really remote possibility. I think one of the two things was more likely to happen. And I think that's still what's going to happen there. And I think a lot of countries are negotiating right now, and there is really are some unfair practices going, with what's going on with tariffs in other countries. So hopefully what'll happen is they'll negotiate those tariffs down, and there won't be as much disruption as far as companies planning and also people planning. I think there will be an impact from some of these things. These tariffs will lead to some higher prices. But right now we're in somewhat of a uncertain territory because we don't really know what the rules of the game are here. It's somewhat, they're trying to do something that is actually makes sense as far as like trying to bring manufacturing here to the United States. But we have to just see whether they're doing it as a negotiating ploy or whether you're doing it as a way to raise revenue. So I can't talk too much more because my voice is going, but anybody have any questions?
So how much has the market and our, portfolios dropped actually since the beginning of the tariffs?
Well, it's interesting when you look at the performance like year to date, it's not really that dramatic, but since tariffs were instituted, it's probably down something, the market's down probably like it depends upon which area you're in, but it could be down as much as 7 or 8%. Like we had at one point, it was down like, double digits. And then we had that one day it was up 9.5%. It's really hard to say, where it is right now as far as, uh, the overall since the tariffs were instituted. But in general, the market wasn't so crazy about tariffs, and Trump did back down from that. But we don't know like what's going to happen going forward because 90 days from now it's not that far away. It's actually right around the corner, and we don't know what might happen with that. I think a lot of countries are negotiating, and it could actually maybe work out okay. But even that being said, like the tariffs that are already been instituted, like the baseline of a 10% tariff is is huge. It's actually much bigger than really has ever been done before. Um, so that's already going to be baked into the prices of things going forward. So things should be, more expensive. And I also, I know companies now are scrambling with not knowing where to get things from because you literally don't know, like, I guess Apple did a really great job of negotiating because they don't have tariffs going on their iPhones and their electronic components and things like that.
At the moment.
So what's that?
At the moment.
At the moment, but that can change. So it seems like it's really hard to know. Lobbying, right now is actually probably a very worthwhile endeavor for a company to do because they could be the winners and losers. But there's also tariffs that they were talking about doing on like pharmaceuticals, and there's other things that can happen with that then too. So, we don't really know what the rules are going to be because the rules can change next week, which is why I wanted to do this seminar as quickly as possible because all the preparation I had to do for the seminar could be completely out of date by the time I got 2 weeks. So I wanted to get something and recorded that would show what I knew at this particular point in time. But in general, like the larger point is, we have tariffs, we have the immigration policy, we have tax cuts, but in general, the economy is strong. The economy is doing okay, even with these things. We don't know the implications of all these things will have on the economy, in the short term or the long term. But in general, we are a strong country, and I think we will be okay from this.
So are there any areas where you're specifically looking to do rebalancing in portfolios, or does all this uncertainty make that really tough to do?
Well, one of the things I did have in the portfolios, there's this fund that looks at the American industrial renaissance. I think there will be a lot of manufacturing being brought back to the United States. So that's one area we added to. We also, I do like I don't really want to overweight towards those Magnificent Seven stocks because I think that they are generally overvalued. So I think there's other areas of the market that I think make more sense from a valuation perspective. And I also like having things like there's things to me that are like really simpler to do. Like there's infrastructure, there's the money that was spent on the Inflation Reduction Act that's already out there and the money hasn't really been spent yet. The money was allocated but not spent. So, I think the one thing that in this country that people can agree on is that we need to have money for bridges and roads and transmission lines and and data centers and things like that. So there's an investment out there where they can invest in those type of things. So I think that right now some of these alternative investments, which will lower the volatility, make sense. And the other thing which most people on this phone have is, the Reese's peanut butter cup, where if the market goes down by 10 and you make 10, that's looking a lot more attractive right now because, we really don't know. I think that that's a fair bet as the market, not to be flippant as to what the market might do, but the market might go up or down 10%. So to have things like that in a portfolio to kind of lower the risk, I think those type of things make a lot of sense.
So have you actually seen some of those downside protections coming into play yet in our portfolios, or is it still too soon to tell?
Well, those things, yes and no. That yes, they've worked, but the problem with those things is they don't show you like it's a year to year type thing. So they're buying options in there. So the answer is it will have an impact if the markets stay down by 10%, you would make 10%. But on an interim value, it's sometimes hard to measure that. But I do think that those things do make sense because in this market, we have a lot of the one thing I can tell you for sure is we have a lot of uncertainty. So anything you can do to reduce the uncertainty by getting you to a narrow range of outcomes, I think makes sense. Okay. Any more questions, Brian? I guess you're the questioner.
Steve, I have a question.
Yes.
Steve, I have a question.
Okay.
So, with the war now with China, basically it's the tariff, but they also buy a lot of our T-bills and bonds. Have they sold off a lot of those bonds right now? Are they squeezing our economy?
There's actually I read something that they was kind of interesting. It showed that a lot of I think Canada you know, they're and other, they got together with the rest of the world, and they basically said like 2 weeks ago, they said, you know what, we're gonna just bond together, and we're gonna sell off the treasury bills, and I think that's what led to the bond price, the yields going up, and that was kind of scary because that's something that Trump didn't really want to have happen. So it is somewhat of a precarious situation to be in. Like if you're gonna thumb your nose at the world and you owe them a lot of money, they could just stop buying your bonds. So but right now, that's calmed down, and the rest of the world is still looking at the dollar as being a safe haven. But that is a concern that it's the Chinese, the Japanese, the Canadians, the Europeans. They own a lot of.
Yeah.
What's that?
No, Mexicans too in Mexico. Yeah.
And Mexicans as well. Yeah. So I mean, all those countries, they can basically say no, that they can vote by selling treasuries. But for now, the dollar. One of one of the wonderful things we have in this country is we have the world currency. But Britain had the world currency at one point, and they don't have it anymore. And you have the world currency, you can do a lot with your deficits and things like that. But when you don't, you have to kind of balance your budget. So that's a concern. But and that's where they have to be careful because we do owe a lot of money to the rest of the world, and that's why in the long run, I would feel more comfortable if we didn't have a huge budget deficit because all we're doing every day by increasing that budget deficit is making us more vulnerable to people around the world saying no, we won't buy your bonds anymore, leading to higher interest rates, which would lead to higher, higher interest expense, which would lead to a higher budget deficit. So it's one of those concerns that's kind of lurking in the background that people don't really focus on.
Yeah.
Anybody else?
I'm just lost. I mean, what is your gut feeling? I mean, I know you're going away. Do you have a feeling that when you come back, it could all be completely different or better or worse? What's your gut feeling?
Oh, when I go to Hawaii for a week, whether the
Yeah.
world will fall apart? No, I'm
Yeah.
confident that the world will be fine in
Okay.
the next week. So I think we'll be okay. But that's the thing is like it literally every day for the since April 2nd or whatever Liberation Day was,
Yeah.
it's been I don't know what's going to happen next. Like you just
Right.
have to look and see, and and I've read what what Trump is trying to do, and it's it could work. I think it's if it's a negotiation, that's one thing. Really, when you have to put your pens down, is when they look at how much revenue they're trying to raise when they're doing, because right now they're looking to do a tax cut. So it's kind of like it's in pencil right now as to how much they're going to raise from tariffs, but it's going to be in pen when they say how much they want to raise from these tariffs, and that's actually going to be interesting to see what they actually looking to do over there, because that's going to be the forecast going forward. So that's what I don't really know the answer is, whether it's a negotiating tool or whether, because Trump has said that he's he loves tariffs, and he said that tariffs will be a revenue raiser, and maybe we'll be able to get rid of the income tax. Now I don't think that's going to happen. I think it's still going to be an income tax, but that's one of the things that he said. We'll see whether he means, he says a lot of things. It's hard to know exactly what he means by that, but as far as that, I don't really know. I think there are a lot of countries are going to negotiate their tariffs to be lower, which I'm hoping that it all works out and it'll be great, and I'll come back from Hawaii and the world will still be fine. I'll just have some pineapples or whatever I'll have from going over there then too.
When are you going to Hawaii, Steve?
Monday.
Monday, nice.
Monday?
Monday, yeah.
Oh, nice.
How come
Going
you're
to
not
the
bringing?
place.
How come you're not bringing your brother?
I'm bringing my wife. We're going to the hotel where we had our 35 years ago, we had a honeymoon at. So we're going over there. So
Wow.
That's great.
So that
So
should be
you've
nice.
fun.
been married 35 years. Congratulations.
Oh, I shouldn't have said that out loud, right?
Wow, 35 years.
Sounds like a long time, right? So, but yeah, anyway, anybody have any other questions, or this took a little longer than I thought, but I went through a lot of information because you know what? There is a lot of information out there.
There is.
I find it all interesting, and I'm sure I'll hear from you all after the phone call as to, what your views and thoughts are on this. But I think we're going to be okay. It's just there's a lot more to digest than usual. That's why this market update took a little bit longer, because there's a lot of stuff that new things that we haven't had to think about before. So
you said this was recorded and that we would be able to access it, because you went through some things pretty fast. How do we do that?
So for those of you who want to see this, so what you need to do is, so anybody who wants to see anything that's recorded here, you need to go to
Why don't you send a link? Why don't you send a link?
If you just go to if you go to heinwealth.com,
okay,
and you go to the 2020 hindsight channel, look over there, you'll see all the previous recordings.
Oh, okay. I'll do that then.
So you'll see the other one, which is the guide to retirement. You'll see other talks we've had in the past. You'll see the YouTube videos. That's where everything is. So and that's really we'll send an email when this recording is available there.
Okay.
But and I realize it's an incredible amount of information that nobody could possibly process all this. But the point of it is that it's complicated, but it's also something that, you know, you have to study it to understand what's going on with it. But the good news is you don't have to study it. I have to study it.
Right,
When I
right.
look on my phone, I can't see the
That's what I was
slides.
thinking too.
So,
So I did have one other quick one. So this tax change, you know, essentially shifting from an income tax to a sales tax based on the tariffs. Should that be better for our portfolios longer term because a lower income tax rate, which would be where we're hitting as we're pulling money out of the 401ks and IRAs?
Well, it all depends. I mean, because, you know, whether it's a value added tax or it's a tax on tariffs or what it is over there, it's all, it all depends upon how much you're spending. If you're somebody who's spending a lot of money, then you're going to be paying more than if somebody who doesn't have a lot of income. So it all depends upon how much you're taking out of your, like, yes, if you're taking money out of your IRAs and you're put in a high tax bracket and you're, you know, you're not spending much money, then yes, then this will actually work out better for you. But if you're actually, you know, somebody who's buying cars and boats and traveling and doing things like that, then maybe no for that then too. So,
Chinese
but
boats.
yeah, you have to see what kind of boats you're buying over there then too
Yeah.
to see. But you know, it's you know, but that's the thing is I don't really know the answer to what they're trying to do, like because they might be, it just could be a negotiating ploy, and that's the thing that we don't really know. But I think that the pundits who I was looking at and studying like last month were all wrong. Every one of them, when I did my market update a
Wow.
month ago, they all said the consensus was we'd have tariffs of 2.5%. And as a baseline now, we're talking about the tariffs being 10% as a low bar. And that's
Yeah.
not including the 30 or, you know, the 30% or the 125% on China. So those are the things that are just like, now 10% looks like, you know, the low case as far as that goes. So we don't really know, you know, what's going to happen with this. But in general, you know, the good news is that compared to the rest of the world, which is why the US can maybe withstand this better,
Yeah.
is the rest of the world is a lot more impacted by exporting. We're not as much we're not impacted on that as much. We actually we actually could potentially withstand like a trade war better than the rest of the world. That being said, I don't think really anybody ever really wins a trade war, but we should be able to withstand it better than the rest of the world because we actually you know, we don't export as much compared to the, you know, like China and Vietnam and South Korea and, you know, all those other places. They're export driven economies. We're really not.
We're like the
So,
big vacuum.
yeah, we're the ones who take all their stuff, right?
Right, right.
Yeah,
The
but
shoppers.
yeah, we're the shoppers of the world, but we have to stop spending less, I guess, with all those different things. But we'll see what happens. But right now, I mean, generally the economy's strong. People have jobs. People are spending. You know, there are some things that are positive. You know, the market's gone down a little bit, which is actually healthy. Like the beginning of the year, the market was fairly expensive. Now it's a little bit less expensive. It's not necessarily a bargain right now, but it's less expensive. And you know, over a long period of time, which is why I wanted to start this seminar with that, over a long period of time, despite all the headlines and all these things going on, the world is good and the market generally goes up. So I don't want to give a negative message to everybody. Generally, it all works out, and as long as people are trying to do the right thing and companies are trying to make money and do the right thing, you know, the stock market should go up.
Well, let's hope so. Let's hope you're right.
So I'll leave it on an optimistic note.
Right.
So
Yeah, sounds good.
everybody have a
Yes.
good night, and we'll
Yeah,
talk to you
Yes.
soon.
Steve.
Have a
Thank
good trip.
you.
Thank you.
Okay,
Bye.
Thank you.
bye.
Have
Thank
a
you.
safe trip.
Thanks.
Yeah, enjoy yourself. Have
Yes.
fun.
Thanks. Okay, bye.
Good night.
Good night, Steve.
Good night. Thank you.
Okay,
Night.
everybody else showing their faces or saying goodbye or what?
I'm saying goodbye.
Saying goodbye. Okay.
Bye. Have a good trip.
Okay, thanks.
Which islands are you hitting?
Going to the Big Island.
Okay. Oh, and next week?
Our kids are
Our
gonna be
kids
there.
are going to be there next week as well.
Where are they going to be?
I don't know which resort, but yeah. Yeah, they're going to the Big Island. I just don't know which resort. So
I'm staying at the Mona Lani. Maybe I'll see him.
could be.
Yeah. It's what I like about that place is that I remember on our honeymoon 35 years ago is that they put chocolate on your pillows twice a day,
Oh,
which I thought was really made me feel special. So this is the real test. Like I'm gonna be disappointed if I don't get chocolate twice.
there we go. Well, let them know when you check in that's the expectation.
So yeah, let me know where your son's gonna be. Maybe it's a good time to meet him.
There
It's
you
a big
go.
island though. But do you
It
know where
is
he's
a big
gonna be?
island.
Do you know where he's gonna be or
No, I don't. Yeah,
No, he's
we'll
not.
double check, but yeah.
My granddaughter wants to see volcanoes.
what's that?
Volcanoes.
Grace wants to see the volcanoes.
She's all excited about volcanoes.
Okay. Yeah. Well, that sounds good. Okay. Which son is this? The one who's in
The
Michigan or
oldest one that lives
Yeah, the
here
oldest one lives here.
with
Yeah.
the two kids. Yeah.
oh the kids are going as well or
Yeah. Oh yeah. Oh
Oh,
yeah.
yeah. First spring break, they're out of school. So
oh nice. Okay. That sounds great. You've been there. You think you went there last couple of years ago, right?
We just came back in February from Kauai, not the other end of the chain.
Yeah.
Yeah, Kauai's beautiful, but it rains so much, you
we
know.
were lucky. We were there 3 weeks. It rained the first night and the last night.
Yeah.
What month were
The
you there?
last day.
3 weeks.
What month?
The end of January through middle of February.
Yeah.
Oh yeah, I was there in January, which they told me was rainy season.
Well, it is. So you get more cloud cover and stuff, but we other than the big storms that came in that first night and a half or day and a half or so,
Yeah.
it was sunny the whole time until it was the day that we checked out of the hotel, waiting to go to the airport at 9 o'clock at night,
Rained all day.
and it poured cats and dogs all day long.
Yeah. But anyway, I will talk to you guys soon, and
Okay.
thanks for joining us.
All right, take care, Steve.
Bye.